Hi, welcome. This is Bert Dohmen with Market Views. Let's take a look at the longer-term view of the markets here. This is the S&P 500 index, and you can see here the up move from 1996 to the top in 2000. March 10th, 2000 was the peak in the Nasdaq. The S&P and the Dow Jones came shortly after that, and then we had this huge bear market here, going down to the October 2002 low. And you can see here, using advanced technical analysis, you can catch these tops pretty nicely here. This one, in fact, on the Nasdaq, we caught right to the exact day of the top, which, we don't always do, but it worked out very well. This was the technology and the internet bubble that burst at that time. And here was the bottom. We were a little late in catching the bottle. I think we missed it by about 6 weeks, which was a big disappointment for me because we like to get much closer to the turn than that. But the bottom, the first part of it, I didn't believe because everyone did believe it. So anyway, we did catch this big up move here going into the October 13th top of 2007. The actual top in the Dow Jones Industrials was 2 days earlier on the 11th of October. So we caught this one very nicely, and we came down here March 6, 2009, and we caught that bottom to the exact day. In our trading services, we said close out all short positions, and then 3 days later, on March 9th, we said buy. This is going to be a very strong rally, and it was. It's still going up. We did have some corrections in the meantime, but it's going up. Now, I ask you, many analysts are now very optimistic. They say that this is a launching platform for the next 4-year bull market. Do you really think that that is logical? After a 4.5-year bull market, will you have another 4-year bull market on top of that? That would really defy all historical experiences. Wouldn't it be much more logical now to think that there's going to be a top somewhere here in January, and then you'll be going down? So anyway, we're on the lookout for that. We don't go against the trend until we get technical confirmation, and our technical indicators will probably tell us again when the top has been achieved. This is the chart of the what's called the Starlet bubble. This is an analyst, and he came up with this a theory that when the cycles here, they keep narrowing as the market goes up, and goes into a parabolic move, and the ups and downs get shorter and shorter in amplitude and in duration until you finally see the exact top. This is a very interesting concept. The chart starts here January 2010, and you can see how it has progressed. Now this here, it seems to be we're getting very close to the ultimate top. Cyclically speaking, this should be in January of 2014. So we're maybe 6 weeks away from that. So it's time to be on the lookout. Enjoy the ride until late December, and then look for the exits. Everybody's got to try to be the first ones out of the exit, and you don't want to be the last one out. So it's usually best to sell a little bit too early rather than just a little bit too late. And this is a warning signal. I cannot see how all the analysts can be so bullish when we are here near the end of the cycle. I just wanted to show this slide here of some important numbers, and just to kind of suggest that maybe the market is not totally random, and that maybe there is more to it, and that it's a very well organized affair. Look at the August 11th, 1982 bear market low. This was a tremendous bear market, 1980 to 82, and the low in the Dow Jones Industrials was 777. Beautiful number. On October 9th, 2002, this was the big 2000 to 2002 bear market. The low on the S&P 500 was 777. Okay, and on March 6th, 2009, this was the global crisis with 2008. The bear market low on March 6th was 666 on the S&P 500. So you can see that Wall Street does have a sense of humor, and that maybe the markets are not random. This is Bert Dohmen signing off with Market Views.